Let me tell you something that most investors will never understand until it's too late. While everyone's chasing the next hot stock, the next cryptocurrency, the next big thing that's going to make them rich overnight, there's a quiet, boring, unsexy strategy that's been creating millionaires for over 100 years. Dividend investing. And I'm going to show you exactly why this is the only strategy that matters if you want real, lasting wealth. My name is Kevin O'Leary, and I've made hundreds of millions of dollars in my career. I've built companies, sold them, invested in hundreds of businesses on Shark Tank, and managed billions in assets. And through all of that, one truth has remained constant. Dividends are the only thing that matters. Everything else is noise. Let me start by telling you a story. Back in the early 1990s, when I was building my software company, The Learning Company, I had a mentor who changed my entire perspective on investing. His name was Sam. He was in his 70s, retired, and living comfortably off his investments. Not extravagantly, but comfortably. He never had to worry about money. One day I asked him, Sam, what's your secret? How did you build enough wealth to retire and never worry about running out of money? His answer was simple. Dividends, Kevin. I only invest in companies that pay me to own them. At the time, I didn't fully understand what he meant. I was young, ambitious, focused on growth. I wanted my stocks to double, triple, go to the moon. But Sam taught me something crucial that day. He said, Kevin, capital gains are a maybe. Dividends are a certainty. Would you rather hope your stock goes up or get paid while you wait? That conversation changed everything for me. Because here's what most people don't understand about investing. The stock market is unpredictable. You can't control whether your stock goes up or down tomorrow, next week, next year. But dividends are cash in that account, real money, predictable income. And the best companies increase those dividends every single year. Let me break down exactly why dividend investing is so powerful and why it should be the foundation of every portfolio. First, dividends are proof of profitability. When a company pays a dividend, they're putting their money where their mouth is. They're not just talking about profits on an earnings call. They're actually sending cash to shareholders. That's accountability. That's transparency. That's real. Compare that to companies that pay no dividends. They might talk a big game about their growth potential, their innovation, their market disruption. But are they actually making money? Are they actually profitable? Maybe, maybe not. You're taking their word for it. But when a company writes me a check every quarter, I know they're making money. I know the business model works. I know there's real cash flow. That's why I refuse to invest in companies that don't pay dividends. If you're not profitable enough to share the wealth with shareholders, I don't want to own you. Second, dividends force discipline on management. When a company commits to paying a dividend, especially when they commit to increasing that dividend every year, they can't waste money. They can't blow cash on vanity projects. They can't make stupid acquisitions. They can't overpay executives while the business struggles. Because if they do any of those things, they won't have cash left over to pay the dividend. And if they cut the dividend, shareholders will punish them. The stock will crater. So dividend-paying companies are forced to be disciplined. They're forced to make smart decisions with capital. They're forced to focus on profitability and cash flow. That discipline protects you as an investor. Third, and this is the big one, dividends compound. This is where the real magic happens. This is where ordinary investors become millionaires. Let me explain how this works, because most people completely underestimate the power of dividend compounding. When you receive a dividend payment, you have two choices. You can spend it, or you can reinvest it back into more shares of the stock. If you spend it, you're getting income. That's nice. That's useful. But you're not building wealth. If you reinvest it, you're buying more shares. And those new shares will also pay dividends, which you can reinvest to buy even more shares, which will pay even more dividends. This creates a snowball effect. Your dividend payments get bigger and bigger over time, not just because the company increases the dividend, but because you own more and more shares. Let me give you a concrete example. Let's say you invest $10,000 in a stock that yields 3% and increases its dividend by 7% every year. If you take the dividends as cash, after 25 years, you'll have received about $17,000 in dividend payments. Not bad. But if you reinvest those dividends, after 25 years, your position will be worth over $60,000. And you'll be receiving about $3,000 per year in dividends. That's the difference. That's the power of compounding. And here's what's even more powerful. The longer you let this process run, the more explosive it becomes. After 30 years of reinvesting, your $10,000 investment is now worth over $90,000 and paying you $5,000 per year. After 35 years, you're looking at over $130,000 in value and receiving about $8,000 annually, all from a single $10,000 investment that you never touched. Now imagine you're not just making one $10,000 investment. Imagine you're investing $1,000 every single month for 30 years. This is where it gets really interesting. This is where you start building generational wealth. If you invest $1,000 per month into dividend-paying stocks with an average yield of 3% and 7% annual dividend growth, after 30 years, you'll have invested $360,000 of your own money. But your portfolio won't be worth $360,000. It will be worth over $2 million if you reinvest the dividends. And here's the kicker. You'll be receiving about $80,000 per year in dividend income. $80,000 every year, forever. That's more than most people make at their jobs. And you're getting it passively, just for owning great businesses. Now, some of you might be thinking, Kevin, that sounds too good to be true. What's the catch? The catch is time and discipline and patience. This doesn't happen overnight. This doesn't happen in a year or even 5 years. This is a 20, 30, 40-year strategy. You have to start early. You have to be consistent. You have to reinvest those dividends, even when it's boring, even when the market is down, even when there are sexier investments tempting you. But if you do those things, if you have that discipline, the results are virtually guaranteed. Because here's what's beautiful about dividend investing. You don't need the market to cooperate. You don't need your stocks to go up. Obviously, it's nice when they do. But even if the stock price stays flat for 10 years, you're still getting richer because your dividend payments keep growing. Your number of shares keeps increasing. And eventually, when the market does recognize the value of these great businesses, you'll have accumulated so many shares at good prices that your returns will be spectacular. This is exactly how I invest my own money. My entire portfolio is built around dividend-paying stocks. I only buy companies that pay me to own them, and I'm ruthless about it. If a company cuts its dividend, I sell immediately. I don't care what the excuse is. I don't care if it's temporary. A dividend cut is a breach of trust, and I'm out. But companies that consistently raise their dividends year after year, those are the companies I want to own forever. Let me tell you about some of my favorite dividend investments and why I love them. Johnson & Johnson. They've increased their dividend for 61 consecutive years. 61 years. That means they raised their dividend every single year since 1963. Think about that. Through recessions, through market crashes, through the financial crisis, through COVID, they kept raising the dividend. That's the kind of company you want to own. Procter & Gamble. 67 years of consecutive dividend increases. They make products that people need every single day. Toothpaste, diapers, laundry detergent. Recession or no recession, people buy these products. That predictability translates into predictable cash flow, which translates into reliable growing dividends. Coca-Cola. 60 years of dividend growth. Warren Buffett has owned Coca-Cola since 1988, and he's never sold a single share. You know why? Because the dividend keeps growing. Buffett now receives about $700 million per year in dividends from Coca-Cola. His original investment was $1.3 billion. So he's getting a 54% yield on his original cost. That's the power of holding dividend growers for decades. Eventually, you're earning massive yields on your original investment. These companies, and hundreds like them, are dividend aristocrats. They've raised their dividends for at least 25 consecutive years, and the track record is clear. Dividend aristocrats outperform the market over the long term with less volatility. Why? because they're high-quality businesses with strong balance sheets, competitive advantages, and disciplined management teams. They're boring. They're not exciting. Nobody's talking about them on social media. But they're making their shareholders rich quietly, consistently, year after year. Now, let me address some common objections to dividend investing, because I hear these all the time. Objection number one, dividend stocks don't grow as fast as growth stocks. My response, so what? I don't care if my stocks double next year. I care if I'm still getting paid 30 years from now. Growth stocks are great until they're not. How many high-flying tech stocks from the dot-com boom went to zero? How many cryptocurrencies that were supposed to revolutionize finance have crashed and burned? I don't want to gamble on the next big thing. I want to own boring, profitable businesses that pay me consistently. And by the way, many dividend stocks grow just fine. Look at Microsoft, Visa, Home Depot. They pay growing dividends and their stock prices have crushed the market. You can have both dividend income and capital appreciation. They're not mutually exclusive. Objection number two, dividends are taxed, so they're inefficient. This drives me crazy. Yes, dividends are taxable in non-retirement accounts, but so are capital gains when you sell. And at least with dividends, I'm getting cash flow without having to sell my shares. I can pay my bills with dividend income and never touch my principal. Plus, qualified dividends are taxed at favorable rates. And if you hold dividend stocks in retirement accounts like IRAs or 401ks, there's no tax until you withdraw the money anyway. So the tax argument against dividends is weak. Don't let it discourage you. Objection number three, I'm young. I should focus on growth now and dividends later. Wrong. Dead wrong. If you're young, dividends are even more powerful for you because you have more time for compounding to work its magic. Remember that example I gave earlier? The difference between 25 years and 35 years of dividend reinvestment is massive. Every year you wait to start is a year of compounding you're losing. You can't get that back. So if you're in your 20s or 30s, dividend investing should be your top priority, not speculation, not trying to hit home runs. Boring, consistent dividend reinvestment. Do that for 30 or 40 years and you'll be wealthier than 99% of people. Let me share my personal dividend investing strategy, the exact approach I use. First, I only invest in companies with at least a 10-year track record of dividend growth. I want to see that they're committed to increasing the dividend year after year. 1 or 2 years of dividend growth doesn't mean anything. But 10 years, 20 years, that's a pattern. That's a culture. That's a commitment. Second, I look at the payout ratio. This is the percentage of earnings that the company pays out as dividends. I want to see a payout ratio between 40 and 60%. Not too low, because that means they're not sharing enough with shareholders. Not too high, because that means the dividend might not be sustainable. A 50% payout ratio is ideal. It means they're paying out half their earnings as dividends and retaining half to reinvest in the business. Third, I look at dividend growth rate. I want to see consistent dividend growth of at least 5% per year, preferably higher. If a company is only growing its dividend by 2 or 3%, that's barely keeping up with inflation. I want real growth in my income stream. Fourth, I diversify across sectors. I don't want all my dividend income coming from one industry. I own banks, utilities, consumer staples, healthcare, technology, industrials, real estate. If one sector struggles, the others can pick up the slack. Fifth, and this is critical, I reinvest all dividends automatically. I don't think about it. I don't touch it. It just happens. Because if I had to manually reinvest every dividend payment, I might get lazy. I might spend it. I might talk myself out of it. But with automatic dividend reinvestment, I don't have to make that decision. It just compounds silently in the background, making me richer. Sixth, I add new money consistently. I don't try to time the market. I don't wait for corrections. Every single month, I invest new capital into my dividend portfolio. Sometimes the market is up, sometimes it's down. I don't care, because I'm not buying the market. I'm buying cash flow. I'm buying dividend payments. And dividend payments don't care what the stock price is. Whether the stock is at $50 or $100, the dividend is the dividend. Actually, I love it when stock prices fall because my new money buys more shares, which means more dividends, which means faster compounding. Market crashes are the best thing that can happen to a dividend investor who's still accumulating shares. Now, let me talk about some specific sectors that are especially good for dividend investing. Utilities are fantastic dividend payers. Electric companies, water companies, gas companies. These are regulated monopolies with predictable cash flows. People need electricity, whether the economy is booming or in recession. That stability allows utilities to pay reliable, growing dividends. I own several utility stocks, and they've never missed a payment. Every quarter, like clockwork, the dividends hit my account. Real estate investment trusts, or REITs, are required by law to pay out at least 90% of their taxable income as dividends. That makes them dividend machines. Many REITs yield 4, 5, even 6% or more. I own REITs that own apartment buildings, office buildings, warehouses, shopping centers. As long as people need places to live, work, and shop, these REITs will generate income. Consumer staples companies are another favorite. These are companies that make products people buy regardless of the economy. Food, beverages, household products, personal care items. Recession-proof businesses that generate consistent cash flow and pay growing dividends. Banks and financial companies can be excellent dividend investments if you're selective. Look for banks with strong balance sheets, conservative lending practices, and long track records. Many banks have been paying dividends for over 100 years. They've survived depressions, world wars, financial crises, and they keep paying. Healthcare companies, especially pharmaceutical companies and medical device makers, are dividend powerhouses. People get sick whether the economy is good or bad. They need medicine, they need treatments, they need medical devices. That creates stable demand and predictable revenue. Even some technology companies have become excellent dividend payers. Microsoft, Apple, Cisco, IBM, Oracle. These companies generate massive cash flow and share it with shareholders. The key is to diversify across these sectors so you're not dependent on any single industry. Let me address one more thing that concerns people about dividend investing. What happens when you retire and need to live off your investments? This is where dividend investing really shines. Because you've spent decades building a portfolio of dividend-paying stocks, you now have a growing stream of income. You don't have to sell shares to generate income. The dividends provide the income automatically. And unlike selling shares, which depletes your principal, dividends allow you to live off your investments while keeping your principal intact. Even better, those dividends keep growing. So your income in retirement isn't fixed. It increases every year to help you keep pace with inflation. Compare that to traditional retirement planning, where you're told to withdraw 4% of your portfolio each year. With that approach, you're selling shares every year. If the market crashes right after you retire, you're selling shares at low prices, which can devastate portfolio. But with dividend investing, you don't have to sell anything. Market crashes don't force you to lock in losses. You just keep collecting your dividends and wait for the market to recover. This is called sequence of returns risk, and it's one of the biggest threats to traditional retirement strategies. Dividend investing eliminates this risk entirely. Let me tell you about my vision for retirement. I don't plan to stop working completely because I love what I do. But when I decide to slow down, I'll be living primarily off dividend income. I've spent decades building my dividend portfolio. I've reinvested every payment. I've added new capital consistently. I've been patient. And now my dividend income is substantial. It covers my living expenses multiple times over. I could stop working tomorrow and my lifestyle wouldn't change. That's freedom. That's what dividend investing provides. Not just money, but freedom. Freedom from worrying about the market. Freedom from worrying about running out of money. Freedom to spend your time however you want. And here's what's even better. When I pass away, my children will inherit a portfolio of dividend-paying stocks that will keep paying them for the rest of their lives. They can choose to keep reinvesting and build even more wealth, or they can live off the income, or some combination. Either way, I'll have created generational wealth. Not from speculation, Not from taking huge risks, but from the boring, unsexy strategy of dividend investing. This is why I'm so passionate about this approach. This is why I talk about it constantly, because it works. It's worked for over 100 years. It's worked through every market crash, every recession, every crisis, and it will keep working for the next 100 years. But you have to start. You have to take action. You have to commit to the process. Open a brokerage account if you don't have one. Fund it with whatever you can afford, even if it's just $100 a month. Start. Buy your first dividend-paying stock. Set up automatic dividend reinvestment. Then buy another one next month and another one the month after that. Do this consistently for years, for decades. Don't get distracted by the latest investment fad. Don't try to get rich quick. Just keep buying great businesses that pay you to own them. Keep reinvesting those dividends. Keep adding new capital. The results will take care of themselves. 20 years from now, you'll look back at this moment as the turning point. The moment you stopped gambling with your financial future and started building real wealth. 30 years from now, you'll be living off dividend income that provides financial security and peace of mind. 40 years from now, you'll be leaving a legacy of wealth for your children and grandchildren, all because you embraced the boring, proven, powerful strategy of dividend investing. This is the path I've chosen. This is the path that's made me wealthy. This is the path I'm recommending to you. Stop chasing the next hot stock. Stop trying to time the market. Stop looking for shortcuts. Start investing in quality businesses that pay growing dividends. Start reinvesting those dividends automatically. Start adding new capital consistently. Do this, and financial independence is not just possible, it's inevitable. That's the power of dividend investing. That's the secret that most investors will never learn. But now you know. The question is, what will you do with this knowledge?